Good afternoon, folks. Welcome to the weekly wrap up. It is Friday, September 23rd, 2022. I hope everyone's had a good week out there. Pretty ugly week here in the markets. But again, if you've been watching along with my shows, you know that this is not unexpected and not surprising at all. So, anyways, if it's your first time watching the Liberty Call, please give me a big old thumbs up, like, share, subscribe, smash all those buttons so that you can stay tuned in to what's going on in the world. My no nonsense version of what's happening in the economy and in the financial markets. I do my best to give it to you as blunt as possible because most of the people on TV are full of bad stuff. So BS would be the appropriate acronym. Anyways, all right. Ugly week in the markets and a pretty ugly day in the indexes. They did come back off of their lows. For example, the Dow Jones was down like 800 or 900 points earlier, and looks like it finished down 486. So not as bad as it was, but certainly not great. And I think from what I saw, the SP 500 or the Dow finally reached bear market territory with today's downturn. Maybe it finished a little above 20% down from the high, but we'll see where things go long term. All right, well, let's dive in and take a look and see how the indexes did this week. Dow Jones was down 1.62%, closed at 29,590, so it is officially below 30,000 again. SP 500 was down 1.66, closed at 3695. NASDAQ was down 1.8%, closed at 10,867. Small caps were down 2.82%. They took a real beating today. The VIX was up 9.4%. Right now it's at 2992. It did cross over 30 a few times today. I kept getting the alert on my technical software. The other Americas, Canada down 2.75, Brazil down 2.09, Mexico down 1.95. Jumping over to Europe, Germany down 1.97, same with the UK. France was down 2.28, the Euro Stoxx was down 2.29, Netherlands was down 2.76, Spain was down 2.46. Wow, a lot of 2%. Italy down 3.36%. Switzerland down 1.55 and Portugal down 3.37. Both Russian exchanges were in the red today. The MOEX was down 4.61 and the RTSI down 2.79. Lots of red across the Asian markets. In Japan, they were down 0.58. Australia down 1.87. New Zealand down 1.88. Head over to the China markets. The Shanghai down 0.66. The SCSE component down 0.97. The China A50, the lone bright spot, up 0.13%. The DJ Shanghai down 0.76. The Hang Seng down 1.18. And the Taiwan weighted came in down 1.16%. So pretty much a sea of red. See, what was the other green one here? Is this Hungary was up a little bit, but everything else looked ugly. So again, not really surprising based upon everything that's going on right now. I mean, between inflation and all the money printing over the last 2 years and all the uncertainty of what's coming down the pipeline, this really is not that shocking. So, all right, well, let's look and see how the indexes did for the week. Let's see here. The Dow Jones appears to have finished down about 3.63%. The S&P 500 down for the week about 4.29. NASDAQ looks like it was down 4.36. The Dow Utilities finished the week down 3.17, and the Dow Transports, let's start from the bottom of the candlestick, down about 5.29%. So not the best week in the markets. So let's go ahead and pull back and take a look and see at the longer term trend. Right here is the first of the year where my cursor's at, where the little finger or the hand is. And again, we can see this resistance line where, we have, broken through on a few different occasions. I did adjust it off this top peak recently, but we can see we did break through here in August last month, and then it fell back. Did get a little bit of a rally here at the beginning of this month, and that has stalled out too. So now we are at a point where we are pretty much even with where we were at the beginning of 2021 as far as the Dow. So where do we think things are going? From peak of 36,000, I would venture a guess that when we bottom out, it's going to be around this, somewhere around 18,000 to 20,000 would be my prognostication. Again, this is based upon, historical trends, the downturns over the last, 40, 50 years. You typically have about somewhere in the range of about a 50% retracement. So that's kind of what I'm expecting, assuming that the Federal Reserve doesn't come in and create a lot of new money, lower interest rates, all the things that have caused the problems we're dealing with right now. As long as they stay to what they say they're going to do, which I have very little faith in. But typically the Fed comes in and they call it the Fed put, where the Fed comes in, dumps a lot of cash into the economy, creates a lot of inflation and price instability. And so then it takes years for everything to get repriced back in at proper levels. And, everything from wages to the cost of, gold and silver, oil, cost of goods, everything, energy. So we shall see. So, what I would look for, if you're a technical trader like myself, you got to break through this resistance line and you got to continue it. So like in this case, here a couple months ago where we broke through, if the trend had continued up this way or even sideways and then up a little bit, I would say, hey, if all the other circumstances that are going on right now weren't there as far as the inflation and all the bad government and everything else, I'd say, well, we probably are headed back in an upward trend. But knowing everything that's going on, like I said, I just don't have a good feeling about at least the next 6 months. I think we're probably going to be in the same pattern for quite a while. So, all right, well, that's everything with that. Let's go ahead and jump into some economic data and see how things came out. We talked about this yesterday. U.S. initial jobless claims came in at 213,000. Forecast was 218, so that's pretty good. Again, looking back historically, we had gotten up to about 260, 250 in that range, and it looks like it's receded over the last couple of weeks. But again, employment looks pretty good. Let's go to the continuing claims. They were at 1.379 million. Forecast was 1.4, so again, below forecast, and it looks like it has been receding a little bit as far as the long-term unemployment numbers. But again, we're going to go through these cycles. If the recession is really what we think it is, there probably going to be a lot more displaced employees when companies start to fail. So that's just my expectation. Moving over to housing starts, came in at 1.575 million. The forecast was 1.445 million. So nice little rebound from last month where we were at 1.404. I think, we covered an article about this earlier in the week. So if you want to go back and, watch that segment, feel free to do so. But I think a lot of it has to do with mostly the biggest jump in housing starts has been in the multifamily, apartments, condos, things like that. So, but there's also, the single family homes is where we're seeing a lot of reduction. The Fed interest rate decision came out on Wednesday. We're currently sitting at the Fed funds rate of 3.25, right on forecast. And you can see on this chart, we went from basically 0.25% to where we're at today at 3% higher than that. So again, I think the next Fed meeting is probably November, if memory serves. So we got 2 months. We got an election in the middle of it, so we'll see what happens in between. U.S. existing home sales fell to 4.80, or I guess last month we were 4.82. This month we're 4.80. Forecast was 4.7, so it did come in above forecast. The U.S. leading index month over month came in at a negative 0.3. Forecast was a negative 0.1, so a little worse than forecast there. So things are starting to lag. We've had a number of months in negative territory here on this indicator. So we'll see if that's a sign of worse things to come. The U.S. Composite Purchasers Managers Index came in at a 49.3. The previous was 44.6. So did, it looks like, we were at 40. That number doesn't look right. So came in at a 49. chart, we were, like I said, 44.6. So we did jump back up a little bit. We're still below the midpoint of 50, which I think is what they use for kind of like, medium. All right. Well, let's go ahead and dive into today's market recap. Also got an article on energy prices and wealth. So let's dive through those. Dow plunges into bear market as recession fears rattle investors. The Dow plunged into to a new low for the year and into bear market territory on Friday as the post-Federal Reserve wave of selling intensified, led by a rout in energy amid fears that a deeper recession is on the horizon. Energy slumped 6%, pressured by a surge in the dollar. That's probably the bigger thing. If you notice that your commodity prices have been falling the last couple of days, it's because the dollars continue to strengthen. It was, what is the dollar index today? It's at 112. When we were talking about it probably last week or earlier this week, it was around 109. So the dollar continues to strengthen, which is putting downward pressure on like your gold, silver, oil, all your commodities, because they're priced globally. And so that's why we're seeing that. So I think there probably going to be a little bit of snapback in the oil prices or the other commodity prices here in the short term. Let's see here. Marathon Corp, Occidental Petroleum, and Kinder Morgan were down each more than 4%. Fears of recession have intensified this week after the Federal Reserve Chairman Jerome Powell signaled that the central bank would remain on mission to curb inflation at the expense of economic growth. With the Fed hiking rates into a slowing economy in which inflation is still well above trend, Morgan Stanley warned that weakness in economic activity will be more broadly spread. The bank cut its U.S. growth forecast to 0% for 2022 from 0.2% previously, and its 2023 forecast to 0.5% from 1.3% previously. The Dow was also dragged lower by more than 6% plunge in Boeing after the aerospace company said it reached a $200 million settlement on charges it misled investors about the 737 MAX crashes. Consumer stocks were also acutely vulnerable to slowing economic growth, fell more than 2% as investors priced in softer consumer spending. Amazon slipped more than 3%, while travel and leisure stocks deepened their losses for the week, with cruise line and casino stocks coming under heavy pressure. Tech stocks also played a big role in the broader market meltdown. Apple, Meta, Alphabet, and Microsoft were down more than 1%. FedEx, meanwhile, fell more than 4% as Wall Street cast doubt on whether the shipping giant's cost-saving measures will be enough to offset falling shipping volumes and higher inflation. The company released fiscal first quarter results that fell short of estimates, but announced plans to ramp up shipping rates and generate total cost savings of $2.2 billion to $2.7 billion. The quote cost saving numbers, while impressive on a headline basis, is likely not nearly as enough to in context of high inflation and declining volumes, in quote Deutsche Bank said in a note. So again, the ugliness is starting to ramp up. So we'll see where this goes. I mean, what I would say is don't panic, because when you panic, you make bad decisions. And as long as you're, for me, this doesn't bother me at all. I'm totally aware this is happening, and you kind of have to put your, build your portfolio for what's going to happen, not what's happening right now, because buying right now, you're not going to get good prices on anything, unfortunately. All right, next up, oil plunges to 8-month low on strong dollar, recession fears. Oil prices plunged about 5% to an 8-month low on Friday as the U.S. dollar hit its strongest level in more than 2 decades, and on fears rising interest rates will tip major economies into recession, cutting demand for oil. Brent futures fell 4.31% or $4.31 or 4.8% to settle at $86.15 a barrel, down about 6% for the week. US WTI fell $4.75 or 5.7% to settle at $78.74, down about 7% for the week. It was the fourth straight week of declines for both benchmarks. It was the first time that has happened since December. Both were in technically oversold territory, with WTI on track for its lowest settlement since January 10th and Brent its lowest since January 14th. U.S. gasoline and diesel futures were also down more than 5%, which would be a welcome thing. Oil tanks as global growth concerns hit panic mode, given a course of central bank commitments to fight inflation. It seems central banks are poised to remain aggressive with rate hikes that will weaken both economic activity and the short-term crude demand outlook, in quote Edward Moya, senior market analyst at data and analytics firm Awanda said. Let me take a step back. People seem to think that there's going to be a global glut of oil, because if the economy slows down, it means there's less, business essentially. Um, but I mean, think back to 2008 and 9 when things were so ugly. Did you drive less? Did you go to work less? Probably not. I mean, yeah, oil got expensive at that time, and I remember complaining that oil prices were so high. I was driving all over the Houston area doing meetings and marketing events and things like that, and it gets expensive when you're having to fuel up your F-150 all the time. So today I drive an F-350, and diesel is not cheap right now, so I don't drive a lot. But but if you still have to go to work and you still have to drive, and people still live their lives, I don't think we're going to see, maybe from a shipping expense, or consumption for like tankers and big trucks and things like that. But for the average person, I think we're probably going to live our lives pretty much normally unless things get really terrible. So, and in my experience, going through the 2000 meltdown and 2008 and 9, people just continue to live their lives. So, they'll skimp on some things to still enjoy doing other stuff. So, all right. The U.S. dollar was on track for its highest close against a basket of currencies since May of 2002. A strong dollar reduces demand for oil by making the fuel more expensive for buyers using other currencies. Quote, we had the dollar expanding higher and pushing down dollar-denominated commodities like oil and growing fears over looming global recession that is coming as the central banks raise interest rates, end quote, said John Kilduff, partner at Again Capital. The Eurozone's downturn in business activity deepened in September, a survey showed, suggesting a recession looms as consumers rein in spending and as governments urge energy conservation following Russia's moves to cut off European supply. Well, why would Russia do that? I wonder. It may have something to do with NATO being a big thorn in their side. That'd be my guess. Wall Street's main indexes slid more than 2% on Friday as investors feared the U.S. Federal Reserve's hawkish policy actions to quell inflation could trigger a recession and dent corporate earnings. Oh, darn. The dollar index reached its highest level in over 2 decades, pressuring oil prices. Russia's launched referendums aimed at annexing 4 occupied regions of Ukraine, raising stakes of war in what Kiev called a sham. On the supply side, efforts to revive the 2015 nuclear deal have stalled as Tehran insists on closure of the UN nuclear watchdog's investigations, a senior U.S. State Department official said, easing expectations of resurgence of Iranian crude oil exports. Insane. So, well, I really don't care about Iran. The reason we are such a heavy on Iran is because of our interests and, butt kissing that we do for the Israelis. Maybe if the Israelis were better neighbors to their fellow Arab people in the region, they wouldn't have so many problems and wouldn't lean on the United States to be the heavy to come in and, be their bodyguard. But hey, what do I know? I think the U.S. government should be involved in any of this stuff. So live and let live. You're a better neighbor when you don't have a big bully to come solve your battles. All right, last article here. Do I fall in America's lower, middle, or upper class? How your income stacks up in the U.S. economic class system. Boy, that's a good article to write. Make people feel bad about how much they have or don't have. All right, the dividing lines that define Americans by wealth class and status have always been blurry. For many Americans, where they fit in the economic ladder comes down to feeling rather than numbers. But do the facts line up with your feelings? Pew Research Center's income calculator is the quickest way to find out that answer to that question. There's a link here if you want to click on that. So see where it takes us. So I guess there's probably so you put in your state, metro area in that state, income before taxes, and how many people are in there, and it gives you an idea of where you fall. All right. Let's see here. But after you find out how you stack up, you may find the more important question is what you do with that information so you can safely keep ascending the ladder. Now, if you're in the upper, based on Pew's analysis, a household of 3 would need an income of $156,600 to meet the definition of upper class, which it defines as household incomes more than double the national median. In analyzing the trends, Pew points out that the wealthiest households are only ones to have seen gains in wealth after the start of the Great Recession between 2007 and 2016. The median net worth of the 20% of the richest 20% increased 13% to $1.2 million. Meanwhile, lowest earners saw their wealth decrease by at least 20% over that same time period. The result is that the wealth gap between America's richest and poorest families has grown into a chasm, more than doubling between 89 and 2016. The middle class. Middle Americans associate themselves with the middle, or many Americans associate themselves with the middle class. In fact, a Gallup survey earlier this year shows that just half of people identify as either middle or upper middle class. According to Pew's calculator, that feeling lines up with with reality when they're earning between 52,200 and 156,600. The research defines middle income Americans as those whose annual income is two-thirds to double the national median when adjusted for local cost of living and household size. In 2021, the median income was $70,784, according to the Census Bureau. However, while household incomes have been trending upward since 1970, Pew's research reveals that most of the increases were seen before 2000. In those 3 decades, the median income rose 41% to $70,800. After 2000, household income had continued to grow at the same rate. The current median would be about $87,000, significantly more than it is now. And the lower group. Based on Pew's analysis, the same 3-person household would be considered low income if they bring in less than $52,200 a year. However, keep in mind that geography matters here. In Kansas City, Missouri, for instance, that national figure represents a middle-class income, but would be considered fairly low in New York City. Duh, if you didn't know that, you're probably on the wrong channel. But what's important to highlight when discussing lower income households is the opportunities for advancement. While middle-class households rely on home equity to build their net worth, and upper class families rely on financial assets and investments to build their wealth, lower income earners have fewer options to get ahead. In fact, research indicates that the wider the gap, or wider the wealth gap, the harder it is for lower income Americans to move up the class ladder. It's important to consider economic status as a holistic snapshot that considers far more than simple income. Researchers have determined that education, location, social connections, and other factors can inform a person's class identity or identification. On top of that, there are less tangible measures of holistic wealth, mental and physical well-being, access to cultural assets, a healthy social network can all factor in as heavily as income and lead someone with a technically lower class income feel as fulfilled as any upper class or upper income earner. Consider too that some high income earners could technically qualify as upper class households, even as debt and other financial obligations leave them practically in much a different place. So do the numbers matter? Maybe, but they can always change. What might matter more is snatching up those opportunities available to your family to continue to keep your household moving up those rungs. And the reason I bring this article up is, while, I mean, just looking at my own income, or my wife and I's, looking at what we make, it's like, we fall into that top group, but it's like, where's the money at the end of the year? Uncle Sam takes a third, that leaves us with 2/3 to, pay for our, the only bills we have are our mortgage and our RV. But, just pay for the other things we like to do. Like currently my wife's in Europe this week. She's flying back tomorrow. And so, I mean, those things aren't cheap. And we like to take trips and go see friends and family. And so, granted, the last 2 years have kind of put a big hamper in that. I usually like to travel back to Houston on a fairly regular basis to go see my clients. And, that's kind of put a big kibosh on traveling. But anyways, like I said, it's, where's the money go is probably the biggest thing. And it's, really it comes down to being disciplined. And, I certainly don't feel upper class. I mean, I'm just a regular guy who dress cheap. I'm a spendthrift when it comes to a lot of things. I don't spend a lot of money on just wasteful stuff like clothes and things like that. So I usually spend it on things I enjoy doing or just socking it away for a rainy day. So anyways, but like I said, the point of bringing this up is, I've seen folks and worked with folks over the years who, they didn't make high incomes, but they were very disciplined about saving. And over a lifetime, they built themselves a very nice nest egg. They were able to retire on their terms and be able to, live a very comfortable life after their working years. And so you don't have to be someone making $250,000 a year to have the means to save up. It just takes time. And that's really, the biggest factor for anyone that I've worked with that's been really successful has been, the dedication to save every single year. Yeah, you give up a little bit today, but the rewards long term are really great. Now let's hope that the those in charge of running the government and running the Fed and all the big financial markets don't screw it up for everybody with what they're doing right now. But those things are kind of out of our control. So anyways, all right. Well, if anyone needs any help with getting their financial plan on track so that they can retire on time and can do the things that are important to them as they get older in life, let me know. Go to dsafinancialgroup.com. I'd be happy to help anyone who needs guidance as far as where to put your assets and the make the most efficient use of your income and so that you can save for the future and not be pulling your hair out when you're 65 or 70 years old. So, all right. Well, that's everything I had for today. Like I said, if anyone needs anything from me, go to dsafinancialgroup.com. All my contact information is there. Hope everyone has a fantastic weekend out there. And it looks like the weather is going to be pretty beautiful here in Colorado. We had a few chilly days the last couple of days. I think it only got up into the 60s. So I think we have the sun and 70-degree weather next week. So I think we're past all of our 80-degree days here in Colorado, at least until sometime probably next April or May. So I've seen, don't even have to open the windows very often in the last week or so. So, which is nice. You're not sweating. But anyways, all right. Well, like I said, everyone have a great weekend. I'll be back on Monday with the weekly update, and y'all take care. Bye-bye.